Welcome to episode 426, Stan Druckenmiller, 10 Lessons. This is an outline of episode 426, lesson 1 to lesson 5. This is an outline of episode 426, lesson 6 to lesson 10. Lesson number 1, he's the father of focus trading.
Well, my idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully. I think, I don't know what they teach at Marshall, but at most business schools they teach, I think, a lot of nonsense called risk-adjusted return and diversification. Ouch. As a money manager, if you look at a normal portfolio, most people will make 70–80% of money that year on 2 or 3 ideas, even though they'll have 30 or 40 things in their portfolio.
Lesson number 2, he's a top-down macro trader. His best bets are against currency, bonds, and interest rates. His records betting on stocks are not as good. Lesson number 3, he's a bear market expert.
So while I started in equities, and that was my bread and butter my first 3 or 4 years in the business, I evolved in other areas. And it's a little bit of back to the future the last 8 or 9 years where I've had to refocus on the equity market. And I also have bearitis because I made my highest absolute returns were all in bear markets. I think my average return in bear markets was well over 50%.
Lesson number 4, he's a Superman trader. For decades, he manages 2 funds, his own fund, Duquesne Fund, and other funds such as Quantum Fund.
It wasn't clear who was running the fund. Well, it was clear it was him, but he was trading very badly, and I was trading very badly, and I flew to Pittsburgh because I had Duquesne at the same time, and he blew out my bond position while I was on the plane. I'd had total autonomy anywhere I'd been my whole career, so I basically called him up on a payphone, that's what we used back then, and resigned. When I came back, he told me he was going to go to Eastern Europe for 5 months, and that he wouldn't be trading, and maybe we were just in each other's hair, and you couldn't have 2 cooks in the kitchen, and let's see whether that was a problem or if I really was inept. His words, no.
Lesson number 5, develop a contrarian thesis.
The only other thing I'd say is too many investors look at the present. The present is already in the price. You have to think out of the box and sort of visualize 18 to 24 months from now what the world is going to be and what securities might trade at. You know, what a company's been earning is ridiculous. It doesn't mean anything. What you have to look at is what people think, what a company's earning, what people think it's going to earn, and if you can see something 2 years, it's going to be entirely different than the conventional wisdom. That's how you make money. My first boss used to say the obvious is obviously wrong. If you invest in conventional wisdom, you're going to lose your butt.
Lesson number 6, how to bet by innings.
But to answer your question, I'll get a thesis. And I like to buy not in the 0 inning and maybe not in the 1st inning, but no later than the 2nd inning. Okay. And I don't really want to pile on in the 3rd or 4th or 5th inning. So I guess examples are the best. But there's a case where we never really averaged up.
Lesson number 7, fund managers must know whether they are hot or not.
Completely irrational. So, and this is important because I don't think anyone has ever said it before. Yeah. One of my most important jobs as a money manager was to understand whether I was hot or cold. Life goes in streaks. And like a hitter in baseball, sometimes a money manager is seeing the ball and sometimes they're not. And if you're managing money, you must know whether you're cold or hot. And in my opinion, when you're cold, you should be trying for bunts. You shouldn't be swinging for the fences. You got to get back in a rhythm. So that's pretty much how I operated. If I was down, I had not earned the right to play big.
Right.
And the little bets you're talking about.
Lesson number 8, Soros' advice on position sizing. You have to have the maximum sizing when you're right.
Where this equilibrium reached a climax.
It's really a once in a decade, and that's when he is George Soros. That's when he just says, you can't have enough of this. And if there's one thing I've learned from him, is that when you're right and you know something, you really feel it, you can't have enough. And the biggest mistake, if I had to sum up his investment philosophy in one sentence, it's that it's not whether you're right or wrong, you just have to have the max on when you're right, and that's his unique innate ability.
Lesson number 9, how to hit home runs. That is 100% return a year.
So Druck also told us that you have to press a hot hand, and that means a hot hand is when you're up about 30 to 40% of the year. You can use that house's money to go for a 100% year and really boost your long-term track record. So many guys get that decent year and they just go to the beach and they said, I'm done. I did pretty well this year. I don't want to try for that 100%. But Druck never stopped. When he had it, when he knew where the market was going, he tried to shoot for the stars. And that's what really contributed to his amazing long-term track record. And
lesson number 10, liquidity over earnings and politics.
Everything for me has never been about earnings. Right. It's never been about politics. Right. It's always about liquidity. Right. Not only in the time frame, we're in the part, and maybe markets don't anticipate the way they used to. I thought markets would anticipate there's no more Euro ECB money spilling over into the US equity market at the end of the year, so this is a good time to take a shot.
Thank you for watching. Please subscribe and leave your questions and comments below. Wishing everyone peace and prosperity.